Hi, everyone. My name is Victor Coronado, Associate Vice President here at K Properties and Investments. I'd like to thank everyone for joining us on DST Essentials with K Properties and Investments, an in-depth look at all things Delaware Statutory Trusts and 1031 exchanges. We will begin with risks and disclosures. This material is not tax or legal advice. Please speak with your CPA and attorney for tax and legal advice. All offerings discussed, if any, are Regulation D, Rule 506C offerings, which are only available to accredited investors, generally described as having a net worth of over $1 million, exclusive of primary residence. Please verify with your CPA and attorney if you qualify as an accredited investor or entity. The information is educational only and is not an offer to purchase securities or DST properties. Such offers are only made through a private placement memorandum, which investors are encouraged to read. Past performance does not guarantee future returns. Diversification does not guarantee profits or protection against losses. Returns are never guaranteed and could be lower than anticipated. All real estate and DST properties may go down in value. Securities are offered through FINRA, member of FINRA and SIPC. FNEX and K Properties are separate entities. Thank you, everyone, for listening in. And now I'd like to turn the call over to Tim Emanuel, our Vice President here with K Properties and Investments.
Hey, Victor. Thank you very much for that. I really appreciate you introducing and handling everything for us today. Today, I'm excited to have our very own Senior Vice President, Alex Madden, joining us on the call. We're going to have a great time discussing DST Essentials with K Properties, where we're going to take an in-depth look at all things Delaware Statutory Trust and 1031 exchanges. Before we introduce Alex, I'm going to start with a little bit about K Properties and Investments and the www.kpi1031.com platform. K Properties team members have helped over 2,200 investors nationwide purchase over 9,000 Delaware Statutory Trust investments. They have over 340 years of combined real estate, 1031 exchange, and DST experience, and have participated in over $39 billion of DST 1031 exchange offerings. The KPI 1031 platform provides 1031 exchange investors access to typically 20 to 40 DST offerings from over 25 different DST sponsor companies, as well as custom DSTs only available to K clients. Please log in today to view our current DST 1031 exchange inventory. And now I'd like to introduce our very own Senior Vice President, Alex Madden. Alex is a industry expert who has been with K for some time now and has helped clients close in excess of $10 billion in DST investments. Today, we're going to be digging into the topic of zero coupon DSTs. Alex, how's it going? Thanks for being with us.
Absolutely. Thanks for having me on, Tim. Always a pleasure to be here and discuss DST Essentials.
Yeah, absolutely. I'm glad we could get together and chat about this topic, as it's getting more and more important as we are entering a economic cycle where debt is at the forefront of a lot of investors' concern. So why don't you start off and tell us what is a zero coupon DST?
Sure. Well, I think, as we discussed, what is a zero coupon DST? I just want to, outlay some assumptions here. And my assumption is that the listeners know what a DST is. And I'm not going to explain what a DST is, just because that's a different conversation. So if you don't know, I would encourage you to go back, maybe check out some of our prior, conversations and podcasts and whatnot that kind of cover that subject, or speak with a K Properties registered representative. But a zero coupon DST is a very niche kind of DST. And I'll get into why we would invest in a zero coupon and whatnot. But the defining characteristics of a zero coupon DST are typically going to be that it produces zero income. That's kind of a reference in the name there, the zero coupon. And so I'm immediately investors are going to ask, well, why would you invest in something that produces zero income? Well, again, we'll kind of cover that a little bit later. But the zero coupon has a zero income potential, inherent to it, and it typically is going to have a much higher loan to value than what you would see in any other cash flowing DSTs. So those are probably the two defining characteristics that you would see out there in a zero coupon. But other than that, the same 1031 exchange rules, inherent to the Delaware Statutory Trust are going to apply. The pro rata ownership, and all of the other aspects of DST investing are also going to apply. But yeah, the no cash flow and high loan to value is basically what a zero coupon is.
Right. Okay. That's a good explanation. I like how you dug into that. So when would an investor be interested in using a zero coupon as part of their portfolio?
Yeah. Great question. So, as a general rule, I don't think that zero coupons are a great fit for most investors. Now, there's always exceptions, and there are some investors that I think that the zero coupon is a really good fit. And so we'll go ahead and kind of dive into that. But as a general rule, the zero coupon is going to be most applicable to investors with an above average loan to value. And so, every investment has its own business plan and risk factors, and, would certainly, invite you to discuss this with your K Properties registered representative and read the PPMs, for the full outlining of the various risks. But when you have an investor, for example, that, may have an 80% loan to value or a 90% loan to value, maybe they had previously done a cash out refinance on their property. And so they have a much higher loan to value. And then for whatever reason, they decide that they want to sell that property and would like to defer the associated taxes by completing a 1031 exchange. Well, as I'm sure many of our listeners know, when you would like to complete a 1031 exchange, amongst other rules, you must purchase equal or greater value of your relinquished property. And so an investor who has a high debt component on their property would very likely need to replace that debt. Now, in the current interest rate environment, and with tighter lending standards and lending requirements, maybe than we had seen in years prior, in that situation, if there was an investor with an 80% loan to value, and for example, right now in the DST market, a lot of the leveraged DSTs were somewhere in the mid 40s to low 50% loan to value in different times and economic cycles. We've seen those numbers in different places, but just kind of describing what we're seeing right now. So for the investor that maybe has an 80% loan to value at this moment, and they're deciding to sell their property, well, the zero coupon could be a very natural fit in order to access potentially higher quality real estate, go passive, all those same aspects that investors like in the DSTs, but they can't get a cash flowing DST that has a high enough loan to value. And so, that would absorb a large portion of their debt. And with the remaining, equity that they have, they could invest in cash flowing DSTs if they wanted to, or, they might need to go completely into that zero coupon. So there's a lot of different ways that, that this could potentially be combined in your DST portfolio for those of you, with a higher loan to value out there. Something that you should definitely discuss, and we can kind of model it out for your particular situation. But in short, the best time, the most practicable time for an investor to use a zero coupon would be when they have an above average loan to value there.
No, I like that. That's a great description. So basically, it's a very efficient way for the DST portfolio to absorb debt and then free up other cash to be able to go into more cash flowing DSTs and hopefully boost that monthly income that the investor is going to realize. I like it. What are some pros and cons of using a zero coupon? That we haven't talked about more. I mean, I guess probably more of the cons. I guess we've talked about some of the pros, but what are more of the cons of using a zero coupon?
Sure. So, one of the things, right off the bat, most investors are not particularly excited about having, an investment that produces, zero income on it. So that's obviously a negative. The investors still own a percentage of that property, And so, if there's any potential appreciation when the property is sold in the future, then, they would be entitled to their percentage of that, their pro rata share. Another reason why investors may not like it is, this is going to vary, substantially from zero coupon to zero coupon. But there may be, limited pay down of that debt. And so, fast forward into the future, you might still need to replace that higher debt component. Then another consideration would be, of course, when it's sold, as I just mentioned, whatever the higher loan to value is, in the future, you would need to replace that again moving forward. So, I think we're going to, kind of dig into the loan terms and kind of how the debt is structured in a moment. But, just keeping in mind that not all zero coupons are like this, but some of them are. You might find yourself in a cycle of just deferring that, kicking the can down the road, so to speak. And then additionally, we are usually going to see longer hold periods on a zero coupon. So it's not uncommon to see, a hold period that would be in the 15, 20-year range on a zero coupon DST. And so we might have a 20-year lease to Amazon, or, to like we've done, NFL teams in the past before, stadiums and that sort of a thing. So that is, that's potentially a pro, potentially a con. Some investors, like the longer hold periods, some don't. And so those are kind of some of the potential downsides, some of the potential upsides that investors like, as a pro rata owner of that DST, you're entitled to any potential appreciation on that asset. The long term is, the further down the road you get, 20 years down the road, it's difficult to make economic predictions. I mean, it's hard enough to do year to year, let alone, a couple decades from now. But investors are entitled to their ownership percentage. And then, investors like it because obviously, if you're using it, hopefully you're deferring a substantial tax liability as well. So, for our investors who maybe had previously done a cash out refi, or for whatever reason just found themselves with a higher loan to value and decided to move forward with a sale, then the zero coupon could save them from having to pay some potential tax on that by using the 1031 deferral.
That's huge. Yeah, that's huge. So does phantom income play into any of this at all? Maybe you could define phantom income for the listeners too.
Right. So the phantom income, what phantom income is when a principal is paid down on a note, that is not typically going to be tax deductible. So if you think about paying down a mortgage on your own home, for example, or a rental property that you use, if you're on a fixed rate 30-year note, the interest on that loan is deductible. The principal pay down is not. So depending on how the loan is structured on a zero coupon, if it's producing zero income and you're paying down the mortgage on that note, paying down the principal, then that's potentially a benefit for you. 15, 20 years in the future, you could see some substantial principal pay downs. However, you could very well likely face phantom income, which is to say you are going to face taxable income because the principal was paid down, but you never actually received that income, never came into your bank account because it paid down the note to the bank. So definitely, a little bit of a complex, tax consideration. Would certainly encourage all of our listeners to discuss this with their CPA and their tax attorney to see kind of how this might factor into their particular circumstance. And certainly your K Properties registered representative could help you get more information in the PPM and with the necessary operators of the different zero coupons. But in short, some zero coupons are structured that there's going to be substantial principal pay down on the note, and that would entail substantial phantom income on a relative basis. And then other zero coupons are structured that there is not substantial principal paydown. And so that would reduce the phantom income, but it would also mean that investors are likely to exit with a high debt component as well. So something to kind of factor in your own financial plans, talk through with your tax team, and we can hopefully put something together if this is an applicable solution for you.
No, that was very helpful. Those are very important factors to consider. One of the other things I was wondering too is, how does an investor evaluate the tenets that are within a DST that's a zero coupon? And are there certain things that are unique to this space, or is just any insight you have here as to I think you'd mentioned before, NFL teams have provided properties that have been used. What have you seen in this space as far as what's syndicated and what's put inside of these DSTs?
Sure. So I think, the zero coupon is, typically a less tantalizing kind of DST than maybe others. And so the longer hold periods, not having to deal with, a 1031 exchange on an investment that's not cash flowing on a more regular basis. We've certainly seen longer hold periods. And so, we would be looking for tenants that are likely to withstand the test of time. So the federal government could be one, large, multi-billion-dollar companies like Amazon could be another, an NFL team, could be another one, as long as their finances are strong and whatnot, or other large corporations. But I think the key is we're looking for very solid corporate backing on this, and we're looking for long lease terms in order to make it something that doesn't need to be dealt with, doesn't need to be exchanged every 2, 5, 7 years, because that could potentially become somewhat onerous with a zero coupon.
I like it. No, that's very helpful. That's very, very helpful. Okay, so just to review, I wrote a couple notes down here too. So in summary, it sounds like the zero coupon can be, for certain investors, especially those with high LTV, an efficient way to be able to handle their debt. But you have to be comfortable with it. The investor's got to be comfortable with being able to have, like you said, a long-term relationship. And they also need to, be able to have an opportunity to review the circumstances and facts and consult with their CPA and attorney about, the different pieces of each individual zero coupon offering, because some of them may pay off more of that debt than others. And so I think that those are just a few things I wanted to make sure we touched on too. Any other points that you want to make before we wrap this up?
Sure. No, I think, this is a complex subject, and chances are, if you're listening to this, if you don't have a high loan to value, the zero coupon is probably not something that is really going to make a lot of sense for you. For those who do have higher loan to values, this could be a very instrumental part of your real estate portfolio. So my recommendation, there's a lot more to be said about the zero coupon. And so, my recommendation would be, if you think that this is potentially an option for you, I would recommend that you reach out to your K Properties registered representative. We can kind of dive into your particular situation. We can get your tax team involved and hopefully find a solution, that's going to make sense for your situation.
That's fantastic. Thank you so much for that, Alex. Well, thank you again for your time today and all that valuable information that you shared with us. We really appreciate it. And please, everyone, log into the K Properties Marketplace at www.kpi1031.com to view 20 to 40 DST offerings from over 25 DST sponsors. Or call K Properties at 855-899-4597 to speak with a K Properties and Investments team member who can speak with you about your situation and potential 1031 exchange options. Thank you to everyone for joining us today on the call. Please do join us next week on Friday at 11 a.m. Pacific and 2 p.m. Eastern on DST Essentials with K Properties, all things Delaware Statutory Trust and 1031 exchanges.